Hello, hi everyone. Welcome to this webinar being organized by the Chinese Business Chamber. Before starting, I would like to invite the President of the Chinese Business Chamber, Mr. Antoine King, to address us a few words.
Okay, thanks, Kate. Just a few words of welcome. Dear CBC, Hualien, South African Chamber of Commerce members, and other guests. Welcome to this webinar on the Finance Bill 2020 via Zoom webinar. My name is Antoine King, and I'm the President of the Chinese Business Chamber, Mauritius. Our moderator for this session is Kate Lee Kwong Wing, who is a barrister and a board member of our business chamber. Presenters will be Johanne Hague of Prism Chambers, Zainab Hisod of ATAX, and Zuleika Abasaku. I take the opportunity to welcome them and to thank them for their precious time devoted to running this webinar. The finance bill is rather more interesting this year compared to previous years due to the impact of COVID-19 and a few more contentious aspects of reviving the economy by transfer of resources from the Bank of Mauritius, curtailing of some workers' rights during COVID-19 period, pension reforms, the solidarity tax of 25% and its application, and opening up of work permits to a lot more people. On this note, I leave it to Kate as the moderator to introduce the resource persons and the topic. Thank you. To you, Kate.
Thank you, Mr. President. As you have mentioned, today's topic for this webinar is the Finance Bill 2020, and which has just been released for discussion and further to the national budget, which has been presented by the Minister of Finance, the Dr. Honorable Ranganathan Badayachi, last month. And it is worth noting that it is also being debated at the National Assembly currently. So I would just like to, at the outset, bring your attention to the Q&A option that our attendees may see at the bottom of the screen. So if you have any questions, just please feel free to write them up, and we'll keep track of them and try to address them during the presentation or after during the Q&A session. So how we will proceed with the webinar is we will have a presentation by our panelists, which will be followed by a Q&A session. So I'm very pleased and very happy to welcome our panelists of experts who will be giving a presentation on the various measures of the finance bill, more particularly on the fiscal measures, which are being addressed in this bill. So I am very happy to introduce Zainab, Mrs. Zainab Hisson, Senior Manager at ATAX. Zainab worked for 6 years in Big Four firms and more than 3 years in a multinational company. She has 10 years extensive experience in advising clients on both national and international tax strategies, including the application of double taxation treaties together with the interaction with the national laws. Zainab is well versed in corporate income tax, value-added tax, individual taxation, tax accounting, transfer pricing, country-by-country reporting, FATCA and CRS. I'm also delighted to welcome Zuleika Abasaku, Barrister-at-law from Prism Chambers. Zuleika is a barrister registered with the Mauritian Bar and the Bar of England and Wales. She completed her legal studies at the University of West England in Bristol and spent a year in Istanbul, Turkey, where she worked as a legal editor at one of Turkey's best law firms. She assists domestic and international clients in a large spectrum of corporate matters and has experience mainly in the fields of company, contract, finance, insolvency, employment, and data protection law. I'm also very happy to have among our panelists Johanne Hague, who will be joining us shortly, slightly later during our webinar. So I will now leave the floor to Mrs. Zeynep Pisson to carry on with your presentation. Over to you, Zeynep.
Thank you very much, Kate. Thank you, everyone, and good evening to all the participants and attendees. So I'm just going to share my screen before starting. Kate, can you see my screen?
Yes.
Thank you. So I'm going to provide an overview of the changes brought by the Finance Bill 2020 to our Income Tax Act, as well as the Value Added Tax Act. So for today's webinar, I'm going to cover the aspects of individual taxation, VAT, and corporate tax. To start with, the buzz of this month have been the famous Solidarity Levy. So unfortunately, the Finance Bill announced that the Solidarity Levy is going to increase from 5% to 25%, subject to a cap of 10%. So this measure will be applicable as from 1st of July 2020. And it is going to apply on what we call the leviable income in excess of 3 million. So previously the threshold was 3.5 million and it has decreased to 3 million. And compared to the pre-budget era, going forward, Solidarity Levy is going to be paid on a monthly basis under what we call the PAYE system, pay as you earned. So what is leviable income? Leviable income for an individual, it is the chargeable income, so all the net income minus allowable deductions, dividend from resident companies or registered cooperative societies or successions, but it excludes any lump sum that the individual has received because of a death, injury, or by way of any pension. And the Solidarity Levy, it remains applicable to resident individuals only. So in order to understand the impact of Solidarity Levy, what is going to happen on the tax bill of the individual? Will it increase? By how much? So I'm going to go through a few practical examples to help you understand better. So normally the impact on the individual, it should be assessed on a case-by-case basis. So I'm going to go through 3 scenarios. And for the purpose of my scenario, we are going to assume that the individual has got 2 dependents and contribution sociale généralisée of 3% is going to apply. My colleague Zuleika is going to touch base and explain CSJ in more detail later. So to start with, under scenario 1, it refers to an individual receiving only emoluments, that is salary of 5 million during 1 year. And if you look at the example, the tax liability at 15% is going to apply normally, and it will result in 672,000 of rupees of normal income tax. However, as you can see, the Solidarity Levy has increased from 50,000 to 371,000. And how this is calculated? So the Solidarity Levy will now be calculated at the lower of 25% of leviable income in excess of 3 million And in this example, leviable income is 4.4 million. So 4.4 million minus 3 million at 25%, or 10% of net income. And when we look at the definition of net income as per the Income Tax Act, it refers to, in this example, it is the 5 million. And the lower of the two gives you the 371,250. Okay. And we have the CSJ, which will now be applicable, that will replace the former NPF. So we have taken the rate of 3% as announced in the budget speech by the finance minister. However, the finance bill didn't, unfortunately, confirm the 3% rate. So we assume that it will be the same as the budget speech. And in this scenario, unfortunately, the tax bill of that person increased by 65%, representing 24% effective tax rate on its total income. Okay, so going on to the next scenario, this is for an owner-managed business that is receiving solely dividend income instead of salary. So as you know, dividend from a resident company is exempt from income tax. So the taxability at 50% won't be applicable. However, Solidarity Levy applies to income from resident companies. So in this example, the amount of Solidarity Levy will be calculated similar to scenario 1. And the increase in tax bill will be 643%. That is 7% effective tax rate on the total income of that person. Now, you might be asking yourself, when will the 10% cap apply? So scenario 3 demonstrates that. So in this scenario, the individual is receiving a salary of 2.5 million rupee and dividend of 5 million from Mauritius, from a Mauritian resident company. So for income tax, the 5 million of dividend will be exempt. So the tax will be only on the salary of 2.5, applying the income exemption threshold. But when you're going to calculate your Solidarity Levy, so if you look at the square on the far right, so it's the lower of 25% of leviable income in excess of 3 million, which gives you 996,000, or 10% of your net income. And in this case, the net income is the 7.5 million. So in this scenario, you'll see that the cap of 10% has applied, and the increase in tax bill is only 136%, with an effective tax rate of 15%. So as you can observe in this scenario, the 10% cap, it is going to apply only on high income earners. So as you're closer to the 3 million threshold, the 25% solidarity will continue to apply. And as you move upwards in terms of income earning, the cap of 10% is going to apply. Okay. Moving on to the measures impacting individual. So the finance bill introduced a new category of dependent, which is the bedridden next of kin. And this is going to include if your father, your mother, or your siblings, your grandparents, and that of your spouse. But I wish to point out that only one person can claim the bedridden next of kin as dependent. So if you're claiming them as dependent, your spouse cannot. Okay, and to be eligible to claim that income exemption threshold on that dependent, you must be taking care of that person, and that person must be eligible to carer's allowance that is payable under the National Pensions Act. Okay, and as every year the income exemption threshold increases, and the table illustrates that. So if we take one example of category B, an individual with one dependent will be eligible to an IET of 435,000 per year. And if you look at the loss column, this illustrates that in the event where your dependent is also deriving income, for example, in excess of 110,000 rupees in a year, then you cannot claim that person as a dependent. And this new threshold will be applicable as from 1st of July 2020. From a value-added tax perspective, the main change introduced by the Finance Bill 2020 was the introduction of VAT on the supply of digital or electronic services by a foreign supplier to a person in Mauritius. So where a foreign supplier is considered as a non-resident of Mauritius and it has no permanent establishment in Mauritius, or and his place of abode should be outside of Mauritius. Unfortunately, we need to wait for the regulations for more details on the type of digital or electronic services that will fall within the scope of this provision, and also what rate is going to apply. But when you look at the finance bill, it says that digital or electronic services, it will include such services that are supplied over the internet or an electronic network, or which will be dependent on information technology. However, this provision actually raises a lot of questions in our mind, such as, for example, whether the non-resident will have to register for VAT in Mauritius, whether the 6 million threshold will still apply, how it is going to be operated. And as most of you might already know, the OECD is currently working on a unified approach under Pillar 1, the report of which is expected to be out towards the end of this year. So whether this new provision will be in compliance with with OECD's recommendation. So the effective date for this new provision will be the Gazette date. From a corporate tax perspective, there were several tax incentives that were announced by the Finance Bill 2020, such as 100% deduction on capital expenditure incurred on electronic high precision or automated machinery or equipment that you have acquired on or after 1st of July 2020. And this measure will be applicable as from 1st of July 2021. But of course, there are conditions that will be applied to it, such as no annual allowance have been claimed on such capital expenditure. Additionally, a double deduction have been introduced for capital expenditure incurred on medical research and development that are carried out in Mauritius, and also on patents and franchises. Of course, there are few conditions applied to it, such as no annual allowance claimed again, and no deduction has been claimed under Section 161A, our transitional provisions. So this measure will be effective from 1st of July 2021. Also, there is an investment allowance on capital expenditure on plant and machinery. So this will be applicable in particular to companies that have been impacted by the COVID-19 pandemic. And if during that COVID period of 1st of March till 30th of June 2020, you have purchased plant and machinery, excluding motor cars, then you can claim 100% investment allowance in addition to your usual annual allowance. Okay, so this is a great incentive that has been announced. And lastly, a 15% investment tax credit has been will be provided for manufacturing companies that have incurred capital expenditure on new plant and machinery, and this will be over a three-year period. For tax holidays, so in a view to boost the blue economy, the educational and nutraceutical sectors, a tax holiday of 8 years will be provided to companies which have started their operations on or after 4th of June 2020. The exemption will notably cover income derived from inland aquaculture in Mauritius, and also to branch campuses which are approved by the Higher Education Commission and which ranks among the top 500 in tertiary education worldwide. And also it will also apply on income derived from the manufacturing of nutraceutical products. So moving on to our last slide. So effective from 1st of July 2021, income derived from life insurance businesses will be taxed in a different way. So the finance bill announced that income from life insurance businesses will be taxed at the higher of the normal tax that is usually payable, calculated as per Regulations 17, or 10% of relevant profit, where the relevant profit is actually the profit attributable to shareholders adjusted for any capital gains or losses. And lastly, with regards to companies, profitable telephony service providers, the Solidarity Levy has been extended to the year of assessment 2020-2021 and any subsequent years. So the way we calculate the tax for telephony service providers have stayed the same, except that 5% of accounting profit has changed to 5% of book profit. But it is actually the same definition, that is profit calculated as per IFRS. So this is it, Kate, from my side. Thank you. So in case you have further queries on tax or VAT, feel free to email us.
Thank you very much, Zainab, for this very detailed and insightful presentation. And I'm very happy now to introduce and welcome Johanne Hague, our main speaker for this webinar. Johanne is a tax expert and founder of Prism Chambers. And I would like now to invite Johanne to conclude on this tax presentation. Over to you, Johanne.
Thank you, Kate, and apologies for running late. Thank you, Zainab, for leading the tax part. So I think that I'm just looking at the comment that someone made on the webinar chat, that the content was too technical for the layman, so apologies for that. I think one thing that we, and hopefully the legal part will be a bit more digestible. Unfortunately, tax by its very nature is very technical. It's very difficult to kind of try to bring it down in simple terms, because the very nature of the beast is technical. Having said that, I think if there are two things that you need to take from the tax part of this webinar, is obviously the Solidarity Levy. And so Zainab has walked through the rules around the Solidarity Levy and also the different scenarios depending on whether you earn mainly emoluments or dividend. Zainab, would you mind just bringing up the slide again for the different scenarios?
Yeah, sure. Here you go.
Okay, thank you. So as you will see, the Solidarity Levy was announced at the finance, the budget speech was announced to be 25%, and that sent shockwaves throughout the business community. The Honourable Minister clarified what that meant in subsequently and in the finance bill. In our opinion, that it was somewhat of a backtracking, but the 25% stayed in. So this has resulted in a confusing scenario where you have to calculate 25% of your leviable income exceeding 3 million, but you also have to calculate the 10% and then compare the two. So based on the different scenarios that we're seeing, there is scope for, I would say, looking at the different income streams. And I wouldn't say playing around with the figures, but rather it's interesting to see that different scenarios result in different effective tax rate. So as you will see, if you earn mostly emoluments, then your effective tax rate is getting very close to 25%. And your effective tax rate here is being used in a layman's term, i.e. your average tax rate over your overall income is getting very close to 25% if you're getting salaries only. However, for those of you who are businessmen and who hold significant shareholdings in your respective companies, you will see that the more dividends that you earn, your effective tax rate is much less. So in scenario 2, you will see that the effective tax rate is 7%. So I think that that's one important thing to highlight, that the mix of your income will determine how much you're going to be taxed under the Solidarity Levy. And obviously, there is one of the comments that we've heard in the market is that the fact that Mauritius is becoming almost like a high tax jurisdiction is going to give rise to aggressive tax planning. We're not going to say that it is not going to be the case. Obviously, some people are going to try to structure their taxes so that it is the most efficient possible. So we're not talking about aggressive tax avoidance, we're not talking about tax evasion, but we're just talking about people are now going to start looking at their affairs, looking how their company are structured, and applying the rules in determining whether they have structured their company in the most tax efficient way. Whereas before, you didn't really need to worry about that because we had a flat rate of 15%. So that's the one thing I wanted to highlight on Solidarity Levy. The second thing that Zainab has talked about is the VAT on digital goods, and that has been the subject of a lot of intense debate in Parliament over the last day or so. We still have to see how it's going to be prescribed and the form in which this is going to take. What kind of suppliers it's going to affect? I think everyone's been talking about Netflix and the use of streaming services, but we still need to see how the regulations will look like. And this for business people, this shouldn't really affect you either way, because the person bearing the ultimate cost is always the customer. But that's something to bear in mind. If you are in a business that has a digital component to it, then the VAT will affect it. I think these are the two main things that we wanted to highlight on tax. Obviously, more people have been worried about the Solidarity Levy, and if you are concerned that your business is not structured in the most tax efficient way, please feel free to reach out to myself or to Zainab from ATAX. Now we will move on to the legal part, but perhaps Kate wants to say a few words before.
Sure. No, I think we can proceed with Zuleika's presentation. Over to you.
Thank you, everyone. Today I'm going to address the legal changes which has been brought by the finance bill, and I'm going to share my screen with you first so that you can see. Yes, so today we're going to talk about first independent directors, the pension, foreign workers and employment, and briefly on insolvency. So first, independent directors. So there is a new requirement. The Companies Act has been amended to provide for a new requirement for public companies to include at least 2 independent directors on their board. So who is an independent director? He's a non-executive director who is not an employee, does not have a material business relationship with the company, does not receive any remuneration from the company except for being a director, does not represent a substantial shareholder, does not have any family ties or significant link with other directors, and finally has not served on the board for more than 9 years. And it is important to note that this requirement applies only to public companies. Therefore, it would be useful to explain what a public company is. There is a presumption in the Companies Act that every company is a public company unless it is specified during its incorporation that it is a private company. There are also certain requirements that a company has to fulfill in order to be considered as a private company. For example, it cannot have more than 50 shareholders and it cannot offer its shares to the public. Moving on now to the Contribution Sociale Généralisée, which is the new pension fund. So I will talk about what is the CSG first. It is basically a pension fund which will replace the NPF. It is a compulsory pension fund for the private sector employees. The contributions that will be made to the CSG will be used to finance any increase in the basic retirement pension, which is currently 9,000 rupees. And the benefit which a person will receive from the CSG upon reaching the age of 65 will be equal for everyone. So the finance bill has clarified when the contributions will be made. So employees and employers will stop contributing to the NPF as from August 2020. Contributions to the CSG fund will start in September 2020. And it is important to note that it will be compulsory for self-employed persons to contribute to the CSG. So in the budget speech, the minister announced that an employee earning up to 50,000 rupees would contribute 1.5% and his employer will contribute 3%. And an employee who's earning more than 50,000 rupees will contribute 3%, while his employer will contribute 6%. But I just wanted to say that these modalities have not been confirmed yet. So we have to wait for the regulations to come to understand whether these will be applicable or not. So how will the contributions be made? The employer will have to deduct the employee's contribution from his salary and pay that to the MRA. And he will be required to file a return to the MRA annually or monthly in respect of the contribution made. So if a person fails to make a contribution, there will be a penalty of 10% and an interest of 1% per month, which will be imposed. The MRA will make a notice of assessment and the contributions will have to be paid within 28 days. If a person is dissatisfied, he may object to the notice of assessment. So briefly, the difference between the NPF and the CSG to understand, the retirement benefit which was received under the NPF was proportional to the amount of contributions that someone was making. Whereas under the CSG, the benefit will be equal to everyone. And this will not depend on the amount of contributions made. For example, an individual who contributes more will receive the same benefit as an individual who contributes less. And I wanted to address the PRGF as well. So to understand the PRGF, the law requires a gratuity upon retirement, which is a lump sum, to be paid to an employee when the employee retires. And this is based on his length of service. And in the past, only the last employer was shouldering this responsibility to pay this lump sum to an employee. And the employee was also receiving this lump sum based on his length of service with his last employer only. But the PRGF aims to rectify this and ensure that every employer who has worked with this employee contributes up to 4.5% of an employee's remuneration to this fund every month, This will ensure that when an employee retires, he will receive a lump sum which reflects his entire length of service with every employer that he had. It should be noted that the employers who already contribute to a private pension for their employees will not be required to contribute to the PRGF, and equally, employees who earn a monthly salary of 200,000 will not be entitled to a gratuity under the PRGF. And although the PRGF framework has come into operation in January 2020, certain payment obligations have been suspended until January 2022. So moving on to our third topic, which is about foreign workers and permits. So the Finance Bill brought an amendment to the work permit, and basically now the work permit and the residence permit have been combined into a single permit. But what does this mean? This means that a person who had a residence permit under a scheme, such as the PDS, IRS, or a smart city scheme, will now be allowed to work without applying for a work permit. In the past, only occupation permit holders, permanent residence permit holders, or persons who were part of the Mauritian diaspora were able to work without a work permit. I want to highlight that nothing has changed concerning work permits in relation to workers who are employed in different industries and factories, for example. So you will probably see that most of the amendments have been made to occupational permits, which is a type of permit issued to foreign investors and professionals who want to live and work in Mauritius. For example, the validity term of these permits has increased, and the minimum investment required to be made to obtain these permits has been reduced. For an occupation permit, the validity term is now 10 years, and for a permanent residence, the validity term is now 20 years. So also non-citizens will be able to acquire any type of residence, will be able to acquire a portion of land in smart cities for residence purposes. And in terms of dependents, the spouses or dependents of occupation permit holders can invest and work in Mauritius, and the occupation permit holders can now bring their parents as dependents. So this is briefly about occupation permits. So now we will move to the changes made for employment. So first of all, some definitions have been amended, such as earnings. It has been clarified that any payment made under any remuneration order will be included in the definition of earnings. This is important as earnings is taken as basis to calculate end-of-year bonus, and given that the definition of earnings is broad in scope, employers have to pay attention to all the items which are included in the definition of earnings in order to pay the correct amount to their employees. Also, the definition of discrimination has been amended to include the term gender. So now it is not allowed to discriminate on the basis of gender. Another important amendment concerns employers who require their employees to switch from full-time to part-time work. This type of agreement has to be made in writing for a specific period of time, and there should be an option to revert back to full-time. The approval of the supervising officer is also required. Until December 2020, the period of time in the agreement cannot exceed 3 months. If an employment is terminated in breach of the conditions laid down by the supervising officer, it will be deemed as an unjustified dismissal. The next amendment concerns extreme weather conditions. So this is not only restricted to heavy rainfall in Mauritius. If there is a warning which is issued by the National Disaster Committee, an employer is not allowed to request his employee to come to work, and he will also have to pay his employee a full day's remuneration when no work could be done due to weather conditions, or a half day's remuneration where the work has stopped before the worker could complete 2 hours. This was, this kind of benefit, public sector employees were already entitled to this, but this has been extended to private sector employees. The next amendment is about special allowance, which the MRA can pay to certain workers. When a worker receives a special allowance from the MRA, he will not be entitled to the negative income tax, which is provided under the Income Tax Act. And this special allowance is only applicable to employees earning up to 50,000 rupees a month. So now I'm going to talk about protective orders. So if an employer goes in front of the redundancy board to make an employee redundant, and the redundancy board orders that an employer should pay severance allowance or a compensation to a worker, then and the employer fails to do that, the court can issue a protective order which prevents the employer from disposing his property in the amount of the compensation to be paid. So he will have to pay the compensation or the severance allowance. Amendments have also been made to provisions concerning end-of-year bonus. Now employees earning up to 100,000 rupees will be entitled to the end-of-year bonus under the Workers' Rights Act. In the past, only employees earning up to 50,000 rupees were entitled to this end-of-year bonus, and end-of-year bonus is more lucrative for an employee compared to the usual gratuity that he was earning, because it is computed on earnings instead of basic salary. And as explained before, the definition of earning includes all sorts of payments, including commission paid to an employee. As for termination of employment, an employer is not allowed to terminate employment of a worker if he has received financial assistance from the government to pay remuneration to his employees. If he does so, the employee can request the redundancy board to reinstate him to his former employment or to pay him severance allowance. For workers who have lost their jobs after the COVID-19 period, the worker will be entitled to an unemployment benefit of 5,100 rupees, but the worker must have worked for at least 1 month and less than 3 months. The next amendment concerns violence at work. So now people who are undergoing a training are also protected against violence at work. And upon receiving a complaint of violence, the employer is required to take an action within 15 days of notification, else he will commit an offense. And lastly, I want to talk about insolvency. It was not meant to be part of this presentation, therefore this will be addressed to those members of the audience who have a knowledge of the different mechanisms under our insolvency laws. So the amendment concerns a voluntary administration process where a deed of company arrangement is being voted at a watershed meeting. If one class of creditors resolves that the deed should be executed and the other class of creditors is against it, the court can interfere upon application of an interested party to order that the deed be made binding on all the creditors. Also, there are several measures which were brought by the COVID-19 Act which have now been repealed. For example, one of the most relevant one is the extension of the period of time for a debtor to satisfy a statutory demand. It is back to 1 month. And this means that when a creditor serves a statutory demand on a debtor who has failed to pay its debts, he will have 1 month to comply with the statutory demand. So these are the amendments, like the main amendments, which have been brought by the Finance Act. Thank you.
Thank you, Zuleika. Johanne, would you like to comment on the presentation?
Yes, thank you, Kate. So a couple of things on the legal aspects. So I'm just going to, whilst commenting on that, I'm just going to answer one of the questions that I've seen on the Q&A about the definition of public company. This isn't an amendment. The definition of public company itself isn't per se an amendment brought by the Finance Bill. So the Companies Act already provides that every company shall be a public company unless it is stated in its incorporation or constitution that it is a private company. So that's already the case. So at the time of incorporation, you would have specified whether it's a private company or not, and typically that's what you would do. And yes, if you're not a private company and you're a public company, correct me if I'm wrong, Zuleika, then you will have to appoint 2 independent directors.
Yes.
So I think one of the disappointing, and we were hoping to talk a little bit more about that on this webinar, but unfortunately the Finance Bill was completely silent on the modalities of the CSG. This is one of the most fundamental reforms brought by the Finance Bill, along with the Solidarity Levy. There are a number of issues associated with that. So first of all, the Finance Bill provides that the regulation will prescribe the terms and conditions of the CSG, the rate, to whom it should apply, whether there's a cap or not. There are so many uncertainties around it, and the Finance Bill is silent on it. This is problematic in itself because one concern is that it gives the Minister of Finance huge powers to determine the scope of the CSG. So that in itself is problematic, and it may open up to some challenge in the future, but we'll have to wait and see what the regulations say on that. The second is whether the CSG is a tax or not. So I don't know whether you've been following commentaries or parliamentary debates on that issue, and whether or not you've joined our first webinar that we did with ATAX and Prism Chambers. But one of the things we highlighted is that they have this concept in France as well, and at their highest court, the Conseil d'État, determined that the CSG, the equivalent in France, is a tax. So the nature of the nature of the charge, because it doesn't just go to pension but also to spend on public debt, it's a tax in nature. The importance of it being a tax in nature is that, again, it opens up to some challenge if it is only private sector employees who have to contribute to that, and again opens up to certain challenge, perhaps on the basis of on the basis of breach of constitution. So that will be interesting when we see the regulations to see whether or not there is scope for challenge on that. The third aspect in which the CSG is also controversial is the fact that there is no cap. Whereas the NPF obviously had a cap of 18,000 something. So the fact that there is no cap means that the cost of employing people could become quite prohibitive. Although the spirit of the CSG is noble in itself because it's trying to rebalance the distribution of wealth among people and the burden of charges across the economy, the fact that there is no cap is problematic. And also it doesn't only apply to employed people, it will also apply to self-employed people. So that will be interesting to see how the modalities work, because obviously self-employed people who are engaged in a trade, so for example professional services, might not earn the same amount every month. So to see how in practice that will work. The MRA will be the relevant entity who will have to oversee and enforce any assessments. But curiously, the CSG itself will be under the Pension Act rather than the one of the Taxes Act. So there's all these grey areas around the CSG that we are waiting to see what the regulations say, but already it is problematic in nature. The second aspect I wanted to talk to on the technical part is that there's obviously been a number of amendments to the Workers' Rights Act. I think Zuleika went through them in quite a bit of detail. And suffice to say, to the extent that you have employees, that it's becoming more protective of employees. So particularly in this difficult period, COVID period, if you are thinking of perhaps having to lay off one or more employees, you'll have to be very careful, not just in terms of what the COVID Act provided, but also now what the new Workers' Rights Act is going to provide once the Act is promulgated. So these are the two main things I wanted to highlight on the legal part. Perhaps that if we could, I don't know, Kate, but I was going to suggest perhaps addressing the other Q&A that we had on the tax.
Yes, thank you, Johanne. Indeed, just to add on what you said, the CHG is indeed, if implemented, will be dramatically affecting and changing the pension landscape. And I would like to thank our attendees who have sent their questions by email prior to the webinar. So one of the questions which we have received was with regard to the timing of the enactment of the bill. So just to read his question, what is the latest expected date for final approval of the bill? Are there any controversial items which may be amended?
Yes,
Johanne,
thank you, Kate. Yeah, of course. So the timing, I think, is dependent on how many walkouts there are going to be in Parliament. I think all of us have been following whether there's been a walkout or not. I don't think there's been so far. So the parliamentary debates are still going on, and I think the approval of the bill will depend on when those debates finish. We are expecting it to be this week. Depending on when it's finally approved, and then it will be promulgated up to that. But I think one thing to bear in mind and not to forget is that even if the bill becomes law this week, there are a number of provisions that would already be in effect. So for example, the Solidarity Levy takes effect from 1st of July. And the CSG will take effect from September. So regardless of when the acts are promulgated, obviously a number of provisions are going to take effect when the act is promulgated, but things like the Solidarity Levy is already in effect. So, and in terms of expected changes, a number of things are controversial. I'm not sure I'm not sure whether there are going to be amendments and whether they will take on board the commentaries made by the opposition. I think what I read in the press, at least, is that the opposition have been very critical of the CSG and the VAT on digital services. But in both those cases, the regulations haven't come out yet. So in the bill itself, I'm not expecting many changes.
Thank you, Johanne. Another question that we have received from our attendees is with regard to VAT. So the question is, can you please elaborate how VAT will apply to online training businesses?
I'm going to take this question, Kate. So the finance bill mentioned that VAT is going to apply on digital services that is supplied over the internet. So if we look at online training services, but unfortunately the bill didn't elaborate on what the scope of digital services will cover. So we need to wait for the regulations to come out to know whether online training businesses will fall into that. But what I wish to point out is, if you look at the current VAT Act, education services and trainings that are approved, that are MQA approved, they are currently exempt from VAT. So whether online training businesses will fall within the definition of educational services and be exempt, or whether it will fall within the scope of digital services and be subject to VAT will really depend on what will be prescribed in the regulations.
Thank you, Zainab. So let me see if we have any other questions. I note that there has been some questions on land transfer tax, but unfortunately we will not be able to respond to that live. Maybe it may be a subject for another webinar. So I don't see any other questions, so I think we will wrap it up here, since we are nearly approaching the time limit as well. So I would like to thank very much our guest speakers today for their time and for the precious advice and insightful presentation. So thank you very much, Johanne, Zuleika, and Zainab. And I'm sure that if our members have any questions, please feel free to contact them, get in touch with them to have more information or any clarification, pending effectively the enactment of the bill and more clarification from the government. So on behalf of the Chinese Business Chamber, thank you everyone for attending, and hope to see you soon for another event. Thank you very much.
Thank you.
Have a good evening.
Bye-bye.